Welcome to Uncovering Trusts, a podcast by the Edison Group, a content-led IR business integrating analyst content, digital targeting, and investor engagement. Each episode will uncover the distinct features and latest developments of a selected listed investment company. So tune in to find interesting investment ideas and to stay on top of what's happening in the investment companies sector. I'm your host, Will Manuel, and today I'm joined by Miloš Pabst, Director of Investment Trust Content at the Edison Group. And today he'll talk about the abrdn UK Smaller Companies Growth Trust, whose ticker is AUSC. Miloš, thanks for joining us today.
Hi, Will. Thanks for having me.
Great. So it's now more than a year since we last featured this trust in our podcast. So can we just start with a brief introduction?
Yes, sure. Launched in August 1993, abrdn UK Smaller Companies Growth Trust has two managers, Abby Glennie and Amanda Yeeman, who form part of a wider small and mid-cap equity team at Aberdeen. This structure allows them to gain valuable perspectives from managers investing overseas, which is important as, in aggregate, around half of UK smaller company revenues are generated outside of the UK. The managers generally invest in companies with a minimum £250 million market cap, so as you can see, they are not seeking micro-cap businesses. Abby and Amanda aim to generate long-term capital growth from a diversified portfolio of around 45 to 50 companies. And while there is no formal benchmark, performance is measured against the Deutsche Numis Smaller Companies plus AIM X Investment Companies Index.
Okay, so as a refresher, let's focus on the manager's investment philosophy and process, because as I understand it, it's a very important part of the story.
Yes, of course. So the overall investment approach, which has proved successful over multiple business cycles, is based on quality, growth, and momentum factors, with the managers following 7 principles for investing in small cap UK stocks. Number 1, focus on quality in order to enhance returns and reduce risk. 2, look for sustainable growth by seeking companies that can deliver consistent year-on-year earnings growth, regardless of the economic backdrop. 3, momentum, which means running the winning names and cutting the losing positions. Number 4, concentrate the research efforts. I will talk more about this in a moment. 5, invest for the long term, which is essentially an early buy-in into the great companies of tomorrow. 6, seek companies with high-quality management teams that tend to have long tenures and may be founder-led. And lastly, number 7, be valuation aware, but this should not be a primary focus. In terms of executing the strategy, the managers use the Matrix, which is a proprietary screening tool and an integral part of the investment process. It has 12 performance indicators, including earnings growth, share price momentum, valuation, and earnings revisions, which is the most important factor with the highest weighting. Now, the Matrix can identify a short list of companies that warrant further analysis, either as initiations or top-ups, or as reductions or complete disposals. Now, importantly, the Matrix focuses the manager's research efforts, thereby reducing the time spent on stocks that, do not meet the required criteria. It also removes any behavioral biases.
Right, thank you. So this feeds in nicely to discussion about the trust's portfolio. Can you give us an idea about its structure and some of its holdings?
Yes, sure. Abby recently noted that although UK economic growth forecasts are lackluster, the trust's portfolio earnings are currently forecast to grow by 16% this year. She divided the fund into 3 growth buckets. The first being resilient UK-only businesses, including investment platform AJ Bell, food producer Cranswick, and Telecom Plus, which provides utility services under the Utility Warehouse name. Secondly, there are leading global businesses that are based in the UK, such as thread manufacturer Coates Group, Bloomsbury Publishing, whose slate includes the Harry Potter books, and Ashtead Group, which is a machinery rental business. The third category is growth via international expansion, including Hilton Food Group, Premier Foods, which has a large portfolio of well-known brands, and Breedon, which is an aggregates company that has recently made a major acquisition in the US. Now, if you look at the trust's top 10 holdings, they make up around 35% of the portfolio. These names cover a wide range of growing businesses, and nearly all these companies are meeting or beating consensus earnings estimates. Cranswick is one of the top 10 holdings. Its senior management team has a combined 100 plus years of experience. The company has a 36-year record of consecutively higher annual dividends, is growing earnings at around 20% per year, and has a robust balance sheet.
Okay, that sounds good. What about the trust's valuation?
Yeah, so this is an interesting one. Over the last 20 years, the trust has traded at a forward PE multiple premium to the reference index, ranging from 2 points during the global financial crisis to 14 points during the global pandemic. It is currently towards the lower end of the historical range, meaning that investors are only paying a modest premium to gain exposure to high quality UK small cap growth stocks, despite a difficult low growth economic environment. Although the trust focuses on capital growth, I would note its dividends. Semi-annual dividends are paid in April and October, with around a third of the total annual distribution as the interim dividend and around 2/3 as the final dividends. So the current yield is around 2.4%.
Okay. Can you please provide us with an update on the trust's performance?
Yes, with pleasure. While the trust has a long-term record of outperformance versus its reference index and peers, it tends to perform better when share prices respond to company fundamentals, when stock markets are challenged, or during periods of low growth. The Aberdeen UK Smaller Companies Growth Trust had a tough period of performance versus the reference index in 2022, as rapidly rising interest rates in response to higher inflation led to a devaluation of growth stocks. Relative performance was, well, unremarkable in 2023, but in 2024, the trust solidly outperformed as investors paid more attention to company fundamentals. Now, looking at peer performance, the trust is one of 11 funds in the AIC UK smaller companies sector with a market cap above £100 million. And it is encouraging to see that its NAV total return ranks second over the last 12 months.
Interesting. Right. So we've discussed the trust in some detail, and maybe now if we could sort of zoom out a bit, because there's a lot of volatility around in global markets. It'd be interesting to understand where UK small cap stocks fit into that bigger picture.
Yes, of course. Now, stock market leaders do not retain their positions forever. The US market has been, as we all know, the only game in town for several years, and this was accentuated over the last 2 years by the outsized performance of the Magnificent Seven large cap tech stocks, which, of course, were seen as beneficiaries of the growth in AI. During this time, there was, well, very little investor appetite for small cap stocks, especially in the UK. But things have changed this year with President Trump's widespread introduction of tariffs and other policy uncertainty. So now the UK stock market is outperforming the US year to date as funds are starting to flow out of the US and into other regions, including the UK. So far in the UK, large cap stocks are performing better than small cap stocks. But if there is increased demand for UK stocks, it seems likely that there will be a trickle down effect into small cap stocks. There is also a potential catalyst from the pension reform, as the government appears to be taking more interest in the very low UK pension fund allocations to domestic equities. If this situation was to change, it could be very supportive for the performance of UK stocks.
Okay, that's an interesting way to wrap up our discussion on Aberdeen UK Smaller Companies Growth Trust. Are there any further comments you'd like to make?
Yeah, thank you. Just a couple of points. Our listeners should remember that over the long term, small cap stocks have outperformed those of larger companies as they tend to have superior growth profiles. More specifically, as there appears to be more interest in the UK market, now may be an opportune time to consider an allocation to UK small cap equities. In very simple terms, according to Aberdeen, looking across the globe, UK small caps is the least expensive asset class versus its 10-year history. So if one was to consider this trust as a good example, the trust comes with a triple discount. Firstly, the UK market is inexpensive versus other geographies. Secondly, UK small cap stocks are inexpensive versus UK large cap stocks. And thirdly, the trust is trading at a discount to NAV. Surely that is worth a look.
It certainly is. So thanks again, Milosh. You've been listening to Uncovering Trusts, a podcast by the Edison Group. If you want to find out more about Aberdeen UK Smaller Companies Growth Trust and other investment companies we cover, please visit www.edisongroup.com.